Good afternoon, everyone. John Hutchinson with Traders Reserve. A quick audio check and video check to make sure you can hear me okay, see the screen okay before we get underway here at 4 o'clock. Feel free to use the chat box. Let me know that things are working today and working properly. And we will get underway in less than a minute. Thanks, Anita. Appreciate it. All right, let's get underway. This is a continuation of last week's discussion. And this is semi-preview of things we'll be working through for this year's 2025 Investors Blueprint Live Conference taking place in February, but actually getting started this month because we kind of need to. I want to get right into details data on a couple of points. One, it's an important week for the S&P 500. Obviously, the Fed is meeting on Wednesday. More importantly, the S&P needs to break back above the top blue line there, the arrow that I drew on the daily chart. Essentially, it needs to confirm a new high. Hasn't yet. Today was a sideways day, but the outcome of the Federal Reserve meeting will give us, I think, a better understanding of the ongoing direction in the market, whether we're going to continue to have this up and down volatility we've had since mid-July, and or whether we're going to begin a new trend, one direction or the other. Not sure which outcome that will be, but we'll talk about that in just a second. Sorry for the puppies barking in the background. Just a second. Let's get a new dog, she said. Let's get two, he said. That was a good idea. All right, so the next up, the second main thing is a yield curve update. You can see the expansion since the yield curve reverted to a positive spread about 10 days ago. And that trend is continuing. That means that yields are falling, prices are rising. That generally signifies that the bond market has a lower level of confidence in the economy in the short term. And that's not generally a positive for stocks right now, but the 10-year yield has stabilized at above 3.6% or above. And if it'll hold there, that should not become a headwind on stocks. But we need to see, or I want to see, what happens with the yield curve after the Fed meets this week. I still think the Fed only cuts a quarter point. None of the economic data last week supported a half-point cut. And more importantly, a quarter point cut this month leaves the Fed with the ammunition they may need in November or December if things were to worsen. One of the best quotes that I came across this week from sources that I follow, people who are ingrained in the Wall Street bedrock, so to speak, was that the burden of proof is on the bears. And what that means is that no economic data right now supports recession. In other words, GDP, employment metrics, I know I talked about them ad nauseum, the ISM, PMIs for the PMIs for the ISM and manufacturing sectors, even though manufacturing continues to be in a state of contraction, because manufacturing is less of our economy than services, the economy is not in a recession. So the burden of proof is on the bears. Now, to that point, one of the trends that I continue to see is Wall Street expectations being too high and too many companies not affirming those expectations. That happened last week in the financial sector. JP Morgan essentially told Wall Street they were nuts with their forward earnings expectations especially for the banking sector. Ally Financial took a huge hit when they reported a significant increase in credit pressures on their customers. I think the stock was down 16 or 17% in one day. The other major the other major data point last week was that inflation steadied. The trend is still lower in inflation, but metrics leveled out, and that will happen. That is a natural outcome of a slowly declining rate of inflation. You will have periods where from a month to a month or across a few months, inflation doesn't move lower. That's market forces. But that steadying of inflation leads me and others to believe that the Fed will only cut a quarter point. And when I look at this chart, the reason I show you this chart is to be aware that Wall Street may overreact to just a quarter point. But at the same time, what we have seen over the last year is Wall Street very good at moving the goalposts. So if they were hoping for a half point, but they only got a quarter point, they'll move that half point to November. And then in November, they'll move it to December, and et cetera. It's no different than at the beginning of the year when Wall Street was originally pricing in 7 rate cuts, which never happened. That moving of the goalposts, I would not be surprised to see. But do we have a short-term sell-off as Wall Street readjusts its expectations forward for the economy and for the market? So those will be the things we'll be watching this week and into next week. The next 2 weeks next 2.5 weeks are data heavy. Not only do we have the Fed on Wednesday, I believe we also have retail sales. Housing metrics come out later this week and next week. And then we get into next Friday, the 27th, I think that is. We have the personal consumptions expenditures, the PCE, which is the Fed's primary inflation indicator, sort of ending the month. And then as we turn into October, we start to get September data. So all of the next several weeks, do not be surprised if you experience more volatility than expected as that data is released and changes potentially the expectations Wall Street has for future rate cuts. That's not where we are now ending the period of neutral policy from the Fed and moving into what would be rate cut policy or accommodating policy. So those are the keys. That's where we are, and that's why the yield curve right now, to me, if it'll simply remain stable and not significantly increase, then I would foresee the market doing no worse than being somewhat range bound, not dissimilar to where we've been over the last couple of weeks in the 54 to 5,600 range. If that continues to steepen that yield curve, I would expect that the market would have to turn lower at some point, likely in October, especially as we head into earnings and we get a better read on forward guidance for 2025 from a large number of companies that are on calendar year earnings. So with that, last week we talked about utilities and a way to use utilities as a defensive hedge inside of your portfolio. We talked at length about the XLU. And more importantly, we talked about this weird dichotomy of a defensive sector that is actually, in a sense, a growth sector because of the increasing delivery demand, even as the economy slows and as volatility has increased in the S&P 500. And that demand is being driven by AI data centers, electric vehicle charging, if you will, centers or posts, I guess is what you call them, and crypto. So as that demand has increased, it is still expected to increase into the future. So this gives us an unusual space where has for much of people's investing lives a sector that is not ever really been sexy by any stretch. And has always been treated as a defensive or safe space for investors in times of turmoil, is now sort of bridging this divide between both defensive and, call it, offensive with potential growth. So we're going to do something, a little bit of an exercise, And although I'm only doing this analysis, I'm going to change my screens here in just a second. Although I'm only doing this analysis on the utilities sector, the process that I'm going to walk you through, which is very simple, can also be used on other sectors, but to identify changes in a trend. And we'll talk about that as we look at some of these different sectors, and where you may be able to spot an opportunity in a sector that may be down but turning up, maybe up but turning down, and that can help you to see times where you may want to stand aside, may want to take advantage of those sectors, things like that. So give me a second to change what I am sharing here. And all right, everybody should see the FinViz platform. You don't need FinViz to do this. There are other systems out there that you can use, or other websites that you can use. But what I've set up, or what I'm going to set up here, is I want to look at the utility sector as a whole first. And one of the things that this particular site gives me is a way to compare a sector or a stock against the broader market as measured by the SPY, the SPY. And when I first started looking at this sector, you can see here in the chart in the middle, the purple line is the SPY. The gold line is the equivalent of equal shares. So owning a single share of the companies that make up or comprise this sector. And the blue line, it would be if you equal weighted your capital across those same stocks. So that's the difference between the three lines that we are looking at. We're going to be focusing on the gold line for the purposes of our discussions, not only in sectors and industries within utilities, but any group of individual stocks here. So the first takeaway that I have when I look at this is going back to that argument that it's a strange sector because it has always been treated as a defensive sector. For what is largely a defensive sector, it isn't trailing the SPY by very much on a 12-month basis. SPY up roughly 25%, and the individual stocks in this sector up just over 20% over a 12-month period. But if we look at this year to date, you can see the metrics in the lower right. Year to date, 21%. 21.8, so almost 22%. So the majority of that gain for utility stocks has occurred since January. And if we look back to October, you could see utilities were actually negative 12% at one point, heading into what were the October lows last year. So the trough here is actually over 30%. From the lows of October to the current highs here in September. That's a pretty significant move. And when you look at this July-August trend into September, that's a breakaway trend. That is consistently ramping up. So what this tells me is there are stocks in this sector that I need to find. There are stocks that are driving higher on price. So the question is, how can I find them? So to do that, I'm going to go back here to the industry section. And I believe this shows on Zoom, the drop-down box. There are 6 industries within the utility sector: diversified independent power producers, regulated electric, regulated gas, regulated water, and renewable. So we're just going to take a quick look at each of these in the same measure. So when we look at what is now diversified utilities, we can see that the performance isn't in this sector, or this industry within the sector. It has made moves, but it is not challenging the SPY. So while there may be stocks worth owning in this sector, we can look at that at a later point in time. The majority of that gain that we were just looking at isn't from this sector. We can also see for the year up 10%, for the half year up 17%. That's pretty good. An April low to a September almost a new high. But we can also see how closely correlated the equal weight and the equal shares lines are. It tells me there's not a great difference in movement in price in the stocks in this particular sector. So given that these are underperforming, I'm not going to go looking at individual stocks in that sector right now. So, and there are only 11 stocks. So even if I did, it wouldn't be a significant amount of time. That's a good thing. I needed to make one more change. I wanted USA and I wanted price over $10 because I don't want penny stocks. There are penny stocks in some of these sectors. I don't want anything to do with them. I don't like penny stocks, not my thing. So I don't buy foreign companies because, again, not my area of expertise. So when I make that change, let's go back to diversified for a second. That left us with 6 stocks. And in independent power producers, that left us with 3 stocks, which is pretty easy to assess. And look at this. So we wanted to know where were the gains that were driving the utility sector to be near the SPY's performance. And it's absolutely in this industry. The equal shares up 152%. For the last 12 months. The equal weight is actually outperforming that slightly at 164. Year to date has doubled. This collection of 3 stocks have doubled. And if we look at this in 3 time frames, long-term, medium-term, short-term, on a 12-month cycle, the long-term trend is higher. The medium-term trend is sideways here. And the short-term trend is higher. So that tells me that there are probably opportunities to choose the right stock. May have to be right about that, but this is certainly a sector that is swinging high again. Whether it outperforms is obviously hard right edge. That's an unknown. But if we were to go look at these 3 stocks, let's see what we can discover. First company is NRG, and just a quick look at the chart there. It kind of matches up with what we are seeing. So long-term trend is higher, medium-term trend is sideways. Short-term trend is kind of higher, but a rainbow trend. So maybe this stock, maybe not. And when I look down at some of the other metrics here, performance for the year, definitely, I mean, up over 100%. Will that continue, right? That's the question. This stock is not expensive on a price to earnings ratio basis. You would only be paying 12 times forward earnings. Excuse me. EPS this year, 12.5%. I'm not sure I believe the 0.6% next year, but we'll see. And it pays a dividend, small 2% dividend. So there are some reasons to potentially own NRG. I'm not going to go into the options change right now because that's more detail than I wanted to get into for this session. We'll be looking at that next week. But the next one is a company that I do want to look at. And this is a company I do think people should be paying attention to, and that's Talon Energy. TLN is the symbol. Note that even in the July and early August timeframes, the stock absolutely had volatile moves lower, but has recovered. There's a breakaway gap up here. I would wait that out and maybe look to buy back at the top of this range here, maybe around the 150s, somewhere in that range. But you could see if you look at the momentum, starting on the left side under volume, look how low volume was. And then all of a sudden, this just significant increase in volume as the stock price has risen. This is a newer company. IPO in June of 2023, so just over a year old. Absolutely on a tear. So this is a company that wrong button. Sorry, company I want to pay attention to. There's no dividend listed. They're not on an index as of yet, but I would expect that they will be at some point. Sales pretty strong. Share repurchasing, great. Okay, interesting. A little bit on the overbought side, not 100% overbought yet, but reaching that point. That's why I say I would wait out this breakaway gap, try to buy shares somewhere in the 150s. And VST, this was a stock that we traded at the wrong time in the 3-stock trading program, right here at the beginning of June when VST was added to the S&P 500. And thanks a lot, guys. So we wound up, I think we got out of that with about a 8 or 10% loss. Just bad. That was just one of those bad luck circumstances. but it has not yet reclaimed this higher range. But it's also negative earnings, negative earnings, negative earnings. That's problematic. So this is year to date 130%, performance over the last 12 months 170. But when we look at this, the long-term trend, yes, up. The short-term trend is, excuse me, the medium-term trend is down. The short-term trend is up. This is one that I would, if you're getting in at or around that 50-day moving average, might be worth trying to hold, but this company needs to prove themselves, and the last 3 quarters, they simply haven't. Missing earnings by 10 cents per share, missing revenue by 100 million plus. That's a concern. So, and there were issues, or there are issues with this company related to their performance on earnings. So this is one of those grain of salt type stocks. Yeah, the move was here. I would want to see some validation in earnings before I really considered adding this as a stock in my portfolio. But I do like TLN for the reasons that we discussed. So let's look at regulated electric for a moment, and we'll go back to the stats. And again, you can see regulated electric close to mirroring the returns over the last 12 months of the SPY. Year to date, 22%. Last 12 months, 18.6. So again, there may very well be stocks here that have potential. There are more, 30 some, 33, right? 33 stocks. That's too many to review right now, but this is a sector that I would look at the performance. Most of that 20% from the zero line in July to 20% now, you can see it here in just in the last 3 months, up 15%. That's a pretty substantial move. That's why I said when I last week, when I said I found the money, so to speak, that is indicative of significant inflow of capital into these companies, into these regulated electric companies. These are companies you probably have heard of or are familiar with: CMS Energy, Dominion, DTE, which is here in Michigan, Duke Energy, Con Ed, et cetera. So many of these companies, if you look at them individually, we would want to look at them on an earnings basis, even on a dividend basis, and on an overall chart basis. When you look at the general charts, you can see like AEE, that's a company that's certainly in a breakaway trend. Following, that one is not as following as closely. CMS is following, not following, following the trend, following the trend. Right, you can just look at a quick look at the chart, tells you that which of the companies would merit attention versus which would not. EVRG is a company. The irony on this company is Jeff was using this stock. It was a constant top performer in the 3-stock strategy in 2023 when we were testing the strategy. And 1 month it would be up, the next month it would be down. 1 month it would be up, the next month it would be down. That was back in 2023. I'd have to go back here to 2023. But you can see right here, this stock has been in a pretty sustained uptrend for a smaller company, and has broken out recently. It's above all of its major moving averages, even pays a 4% dividend. So that's not awful. But I don't need to get, if I'm trying to hedge or protect myself against a major move lower in the markets, I'm not predicting that, but if I needed to, I don't need to get a 50% return, right? If I want to look at these stocks for a 3 or 6 month period, 5 to 10% return is going to help me offset anything that happens to the longer term holdings of my portfolio. So that's how I would be using these to hedge. So if this stock moves from 62 to 70, that's actually more than 10% gain. That's more than going to help offset any potential short-term paper losses in my portfolio that I can leverage with actual gains, excuse me. So anyway, EVRG was the stock. That was one that I do like and would look more at. I want to talk for a second about gas and water. They are absolutely not the sexiest of sectors. And as you can see, not a whole lot of action happening until recently. with a big tick up there over the last couple of days. But these are going to be more safety stocks. So if you need to put money in something that's just going to, it may be 1%, it may be 2%, but again, that can protect you. These would be the sectors that I would look at. Performance for the quarter, 11%, year to date, 6%. Like I said, not sexy, but certainly some opportunities. There are more stocks here, 15 stocks, so plenty to choose from in both in the gas sector and 11 stocks in the water. Water doing a little bit better. You can see this medium-term trend over the last near 6 months is higher. Half year up 20.5%. So somebody's buying water, and water is recession-proof. So that's why I would say this is an area where I might want to look at exposure. And finally, renewables. And this is another sector. This is weird because it's a diverging sector. We have the equal shares above and the equal weight below. So that means one of these stocks likely blew up, or a couple of these stocks did. So it should not have this crossover with the SPY, but individually, there are stocks in here that are significantly outperforming the S&P 500 on a near 3-to-1 basis. Over the last 12 months, even year to date, 3-to-1, 65% for this sector. So that is a positive. And again, not a lot of stocks, 8 stocks. So we can take a look at these, and I can tell you which ones they are. And the two that I really like are Fluence Energy and GE Vernova, but these are one of these is more capital intensive in GE Vernova. This is an IPO along with GEHC, GE Healthcare, and GE Aerospace. These are these breakups of GE. This company is absolutely on fire. You look at it on a monthly basis, 6 out of 7 months higher. Weekly chart looks equally as good. Little range bound here for a period of time in June, July, August, breaking up now in late August into September, which we can see pretty much here. So this is where some of that power has come from. This stock debuted at about 115, if I remember correctly. The open on March 27th, 115. So the stock has nearly doubled, and I don't see any reason right now that would stop. Watch earnings, obviously a miss here, a beat and a miss. So what happens with their next earnings, which should be end of November, I believe. There's an estimated dividend. I wouldn't count on that right now, but this is a company that I would absolutely, breaking out of this range is huge. It's still an early stage company or early stage post IPO. And in a sector that is certainly getting attention. And what else was I looking at? Nope. We're looking at Fluence. Fluence is a little more interesting to me if you're trying to get a rebound company. Again, this is a post IPO back in November of 2021, right into the teeth of the bear market. It bottomed out at just below $10 a share. And recovered, and then has been up and down since. But it's holding a pretty steady base right around $15, $16 as a bottom. So there's a floor in the stock. And when we look at the daily chart, we can pretty much see that floor. I mean, it may break through the $16 level here and there, but it keeps returning above that level. This is, to me, a trading stock, not an investing stock. This is a stock where I would say, and let me move this chart over a little bit here. This is up at almost $22 a share. I might look for a pullback back down here to 20, and then try to get this, get the 21, 22, a 5 to 10% short-term gain. Because there's certainly that kind of action when you look at it, right? This stock moved here from, I'm looking at February, so 18 to 22. Here's another move from 13 to 17. There's a 15 to 20, right? These short-term moves make this more of a trading stock to me. That would be for people who are not necessarily day traders, but more short-term traders. Doesn't pay a dividend, and performance year to date is negative. But you can see that these moves are there. You could even short the stock if you wanted. I don't know that I would, but right, capture any of these little moves again, and a way for you to hedge and capture some small gains from a stock. And was it Constellation was recovering and building up. See when this is another one. A little older of a company, but you can see beaten down during the recession, October low, and has come back off of it on a daily chart. Starting to momentum higher. Missed earnings here by a fairly wide margin. And yet the stock really didn't fall until early September when the market sold off. It is trading at closer to a high, but again, I want to see this maybe pull back a little bit. And then, can I get $3-4 a share out of this and hedge and just protect myself in that way? Looking at RSI, sorry, I caught my eye. It's neither oversold nor overbought, and certainly riding little momentum waves. Very flat volume, not heavily traded. So 500,000, 700,000. All right, 750. Certainly some opportunities there. You can get, if you can capture like a move like this, even part of that move, that's a $7 move total. If you can capture half of that, that's a 15% gain. Again, a trading stock, not necessarily a long-term investment stock on that one. And I think there was one more. Did I miss them? Nextera. Yeah, this is an example of a stock I would avoid. Moving averages crossing over twice, and this trend is simply just down. If we look on a weekly chart, yeah. Now, could this be the bottom? That's a question. But right now, if I'm looking to protect my capital, this is not a stock that I would want to play with because it doesn't have anything to suggest it or to support it. So let's go back to our presentation in just a second. It should be back up. So there are investing and trading opportunities in these different sectors, the industries within the sector, excuse me. The diversified independent power producers, regulated electric, please rename that one, and renewables. I mentioned water and gas. I might come back and look at those as short-term hedges, just someplace where I can get a few percentage points over a 3 to 6 month period. That's where I would look for those opportunities. Most of the companies that I was looking at specifically or generally in the regulated electric were in the 2 to 4% on dividends. And overall, as you see in most of these companies and most of these industries, the trend is higher, which means that money is still coming into them. Now, it doesn't mean that these are not money doublers. These are not necessarily sectors that are going to be 100% gains, but they don't need to be for the purposes that we're trying to attack them. Which is why I'll say you don't need more than 3 to 5 stocks. If you're investing in them, if you're trading them, you could trade a little basket of them, use them alternately. So you might trade one week, a different one a different week. Options are much more difficult across the breadth of this sector. Low volume, low open interest. In most cases, the best you can do is 1 to 3 strikes out of the money. And then after that, the option prices, the premiums simply collapse. They're next to nothing. But that doesn't mean that they can't be traded. Most of these companies only offer monthly options. That can be okay given what you know about options, where you might, just as a rough example, collect $1, set a good till cancel at 50 cents, close it out, repeat it. Right, so you can use these on puts or calls, targeting small smaller premiums, but faster potential trades. Doing it that way. The call side was definitely more active than the put side in a few of the stocks that I reviewed. And we're going to be looking at that a little bit next week with the kickoff of the Investors Blueprint Live conference, because we're going to keep working our way through this and another sector. For opportunities like this, where can we stash cash, get an overall 5 or 10% gain in 3 to 6 months, just in case something bad happens. So again, then the alternative too is what we do in Income Masters in the perpetual income process, selling puts in an effort to with the purpose of taking assignment at a specified price, holding shares and selling calls, and potentially collecting dividends through that holding period. Southern Company and actually, we've traded Next Era Energy, and we're trading one more, which is now escaping me right off the top of my head. But we have been trading some of these companies in that process, or using that process, excuse me. And so I think that there are other opportunities for you to use that or extend that process to generate income through options, even though they have lower open interest and lower volume and lower premiums. Doesn't mean they're poor. So that special session will be next Monday, September 23rd. We'll be looking at how to use stocks and ETFs to hedge. We'll build a short-term plan together, looking at 3 to 5 utility stocks, and whether it's better to own or trade those stocks. If there's an options tactic, which option tactic is best for those stocks. And we'll also look again at the XLU and whether or not there are ways to leverage that within this concept and this plan. So that will be our session next week, and that'll be in the the Investors Blueprint Live 2025 room. So next week there will not be an IQ session. I think we'll be back September 30th. So again, if you don't have a ticket, early registration is still open. The conference is the 24th and 5th of February. That's a Monday and Tuesday, 2 full days, roughly 8 a.m. to 4 p.m. From Boca Raton or in Boca Raton, Florida. And you can change your ticket. You can attend live or virtual. And we're also holding monthly sessions in advance of the conference. So we'll be doing one in September, October, November, December, and January. All of those will be held virtually, so easy to attend. But your ticket overall includes the 5 pre-conference webinar events starting next Monday at noon Eastern. The Income Madness event, which will be held in February, 3 days just before we get together for our Investors Blueprint Live, and 2 days while we are together during Investors Blueprint Live. The main event being February 24 and 25, plus recordings of all sessions, slide decks, and PDF presentations. So again, next Monday is the first pre-conference webinar event, and we're looking at how to hedge or protect against short-term volatility. And that'll be at noon Eastern. The early registration is still open. That's a $200 savings on the regular price. Seats still remain, and the deadline will be next Sunday for early registration. After next Sunday, the regular price will go into effect. So from now until next Sunday, you can still save the $200 on the ticket. That's the deadline. After next Sunday, because we will now be in the event state, the tickets will be on at regular price. So next Sunday, 11:59 p.m. Pacific time, will be the early registration deadline. If you do not already have your ticket, if you already have your ticket, can't wait to see you, whether it's next week in a webinar or next February in Boca Raton. And remember, those of you who bought virtual tickets, if you decide you want to be in Florida instead, you can contact Leslie in support and ask her for if their seats are still available, and she'll take care of you on that. And give me just a second to copy this. Just in case you're on the Zoom, I'll put that link for tickets in the chat box to you there. It's here also in the chat box on the Traders Reserve Live website. Don't think I have any questions here. Let me double check. I got one. Hang on a second here. TLN has an interesting credit spread for this Friday. 160, 156 put gives a 53-cent credit for this Friday. I can't tell you to trade it. obviously, Anita, and I'm sure you know that, but that's actually a far better return for a credit spread than I would have expected. Uh, 400. I mean, that's a 12 and a half. Was it 12 and a half? I can't do the math in my head today. I don't do math on Mondays as well. But that is not a bad return for a $4 spread. Um, so that, like I said, there are opportunities to use options and different options tactics, which is why we'll be exploring some of that next week in the first IBL session. So thanks, Anita, for sharing that with us. And let's see, we got anything else in here? Everything is all good. So that's it. So if you have a ticket for IBL, I will see you next Monday at noon Eastern. We'll probably run 45 minutes to an hour next Monday. And if not, the next IQ event will be the following week, September 30th at 4 p.m. Eastern. No, the 30th will be at noon Eastern. So we'll make sure that everybody knows that we have that time change. So outside of that, I'm John Hutchinson with Traders Reserve. Thanks for joining me today. And we will look forward to seeing you in your next trading session or our next webinar, whichever that happens to be.